Two people, same neighborhood, same house, same bank, same loan amount, but one person pays $200,000 more than the other over 30 years. The only difference? The day they applied for their mortgage. One applied when rates were 3%. The other applied when rates were 7%. Same house, same bank, $200,000 apart. That is the power of a mortgage rate. And most people have absolutely no idea how these numbers are decided. They just walk into a bank, accept whatever rate they are offered, and sign a 30-year contract without understanding what just happened to them. Today, that changes. I am going to show you exactly how mortgage rates are determined, who controls them, why they go up and down, and how you can get the lowest possible rate when it is your turn to buy. Welcome back to USA Money Explained. I'm UNUS. In the last video, we talked about inflation, and I told you that once you understand inflation, mortgage rates become crystal clear. Mortgage rates and inflation are connected at the hip. So let's start at the beginning. What is a mortgage rate? When you borrow money from a bank to buy a house, the bank charges you interest. That interest is called your mortgage rate. 3%, 6%, 7%, charged on the entire loan amount every year for 30 years. So even a small difference in your rate makes a massive difference in what you pay. Let me show you with real numbers. You borrow $300,000 to buy a home. At a 3% interest rate, your monthly payment is about $1,265. Over 30 years, you pay about $155,000 in total interest. Now, that same $300,000 loan at 7%, your monthly payment jumps to $1,996. That is $731 more every single month. Over 30 years, you pay $419,000 in interest. Same house, same loan, but at 7%, you pay $264,000 more. That is more than the price of a second house. Gone. Just because of 4 percentage points. Now you understand why this matters. So who actually decides mortgage rates? Most people think it is the bank. It is not that simple. There are 3 main forces that determine your mortgage rate. Force number 1, the Federal Reserve. The Fed is America's central bank. It controls the federal funds rate, the rate banks charge each other to borrow money overnight. When the Fed raises this rate, it becomes more expensive for banks to borrow. So banks pass that cost onto you. Your mortgage rate goes up. When they lower it, banks borrow cheaply. Your mortgage rate comes down. This is why every single Fed announcement directly affects your mortgage. Force number 2, the bond market. Most people have never heard of this, but the bond market has more influence on mortgage rates than almost anything else. Here's how it works. Banks do not keep your mortgage on their books forever. They package it up and sell it to investors as a mortgage-backed security. These investors compare mortgages to the 10-year U.S. Treasury bond, the safest investment in the world. If Treasury bond yields go up, investors demand higher returns on mortgages too, so mortgage rates go up. If Treasury bond yields go down, mortgage rates follow. Where the bond goes, the mortgage rate usually follows. Force number 3, inflation. We talked about this last time. Lenders hate inflation. Here's why. If you lend someone $100,000 today and inflation runs high for 30 years, by the time they pay you back, those dollars are worth much less. So lenders build inflation expectations into mortgage rates. When inflation is high, mortgage rates go up to protect lenders. When inflation is under control, mortgage rates come down. This is exactly what happened from 2022 to 2023. The Fed raised rates aggressively to fight 9.1% inflation. Mortgage rates went from 3% in January 2022 to over 7% by late 2022. In less than 1 year, people who locked in January 2022 saved hundreds of thousands of dollars compared to people who waited until December. Same year, same house prices, same bank, but completely different monthly payments. Now, beyond these 3 forces, there is a 4th thing entirely in your control: your personal financial profile. Even when the average rate is 6%, not everyone pays 6%. Some pay 5, some pay 7. Here's what determines which one you get. Factor 1, your credit score. This is the single biggest personal factor in your rate. A credit score above 760 gets you the best rates available. A credit score below 620 could add 1 to 2 full percentage points. On a $300,000 loan, that difference costs tens of thousands of dollars. We covered how to raise your credit score in the last series. Watch that video before you apply for any mortgage. Factor 2, your down payment. The more money you put down, the less risk for the bank. Less risk for the bank means a lower rate for you. Putting down 20% or more unlocks significantly better rates and eliminates private mortgage insurance, an extra monthly fee that can add hundreds of dollars to your payment. Factor 3, your debt-to-income ratio. Lenders look at how much of your monthly income goes toward debt. If your total monthly debt is below 36% of your income, you are in a strong position. If it is above 43%, banks get nervous and charge you more. Pay down your debts before you apply. Your rate will thank you. Factor 4, the loan type and term. A 15-year mortgage almost always has a lower rate than a 30-year mortgage. The bank gets their money back faster, so they take less risk. An adjustable rate mortgage, called an ARM, starts lower but can rise over time. During high-rate periods, many buyers choose an ARM, then refinance to a fixed rate when rates eventually drop. Now, here's the most important practical advice in this video. How do you actually get the lowest rate possible? Step 1. Fix your credit score before you apply. Spend 6 to 12 months paying down debt and getting your score above 760. This single step could save you hundreds of dollars every single month. Step 2. Shop multiple lenders. Most people get one quote and accept it. This is a massive mistake. Getting quotes from 3 to 5 lenders could save you half to 1 full percentage point. On a 30-year mortgage, that's tens of thousands of dollars saved. Always compare. Never accept the first offer. Step 3. Watch your timing. Mortgage rates move constantly. Watch Fed announcements and bond yields. When both are falling, it may be a good window to lock your rate. Step 4. Buy points. You can pay upfront fees called points to lower your interest rate. 1 point costs 1% of your loan amount and reduces your rate by about 0.25%. If you plan to stay in the home more than 5 to 7 years, buying points saves you money. Step 5. Refinance when rates drop. If rates fall more than 1% below your current rate, refinancing lets you replace your old mortgage with a new lower rate one. Plan to stay long enough to recoup the closing costs, and it is almost always worth it. Now, one final thought. Mortgage rates feel like something that happens to you, but you now know that is not entirely true. Yes, the Fed, bond markets, and inflation all play a role. You cannot control those, but your credit score, you can control. Your debt-to-income ratio, you can control. Your down payment, you can control. The choice to shop multiple lenders, you control. The people who get the best mortgage rates are not the lucky ones. They are the prepared ones. So let's do a quick recap, USA Money Explained style. 3 forces determine mortgage rates: the Federal Reserve, the bond market, and inflation. When the Fed raises rates, mortgage rates go up. When inflation is high, lenders protect themselves with higher rates. 10-year Treasury bond yields move with mortgage rates. 4 personal factors you control: credit score, down payment, debt-to-income ratio, loan type. Credit score above 760 gets the best rates. 20% down unlocks better rates and eliminates mortgage insurance. Always shop 3 to 5 lenders. Never accept the first quote. Refinance when rates drop more than 1% below your current rate. That is how mortgage rates are determined. And now you are more prepared than 90% of home buyers in America. If this video helped you, hit that subscribe button right now and watch the next video in this series: How Americans Actually Build Wealth, Step by Step. I'm UNUS. See you in the next one.